Good day everyone. We are the Group 5 and today we are discussing the monetary policy and macroeconomic stability. This report covers the relationship between monetary policy and macroeconomic stability, including the role of monetary policy in promoting economic growth, reducing inflation, and maintaining financial stability, and also explore the trade-offs involved in monetary policy decision and the challenges of implementing monetary policy in different economic conditions. What is monetary policy and macroeconomic stability? Monetary policy and macroeconomic stability refer to the actions taken by central banks such as Bangko Sentral ng Pilipinas or BSP to maintain the economic stability of a country. Monetary policy plays a critical role in the overall health of an economy by influencing the availability and cost of money and credit. Central banks such as the Federal Reserve in the US or the Bangko Sentral ng Pilipinas use monetary policy to achieve macroeconomic stability, which includes promoting economic growth, reducing inflation, and maintaining financial stability.
Good day everyone, my name is Michu Nang. I will tackle the role of monetary policy. This report aims to provide a comprehensive understanding of the complex interplay between monetary policy and the economy. Monetary policy is a powerful tool used by central banks to manage the economy. The first one is promoting economic growth. Promoting economic growth means creating an environment where businesses thrive, people find jobs, and the overall economy expands. It's about increasing the production of goods and services, leading to a higher standard of living for everyone. Promoting economic growth involves creating jobs, helping businesses succeed, and producing more goods and services, which ultimately leads to a better life for everyone. Imagine a small bakery that wants to expand and hire more bakers. If interest rates are low, borrowing money to buy new ovens or hire more staff becomes more affordable. This encourages the bakery to invest, leading to job creation and increased economic activity. Number 2, reducing inflation. Inflation is like a silent thief eroding the value of your money over time. It means prices for goods and services are rising rapidly, making it harder for people to afford the things they need. Inflation is when prices go up quickly, making your money worth less. It's like your money slowly disappears, making things harder to afford. For example, if the central bank raises interest rates, it becomes more costly for consumer to borrow money for things like cars or houses. This can lead to a decrease in demand, helping to slow down price increases and keep inflation under control. And the last one is maintaining financial stability. A stable financial system is like the foundation of a house, providing a secure base for the economy to grow. It means banks and financial markets are functioning properly, able to withstand shocks and continue providing essential services. This is like a strong foundation for the economy. It means banks and financial markets are working well, so they can keep providing money and services even when things get tough. Imagine a bank facing a sudden loss of deposits, putting it at risk of collapse. The central bank can step in as a lender of last resort, providing emergency loans to prevent the bank from failing and causing a wider financial crisis.
Good day everyone. Today I'm going to share with you the trade-offs of monetary policy decisions. Economic growth versus inflation control. Monetary policy geared towards stimulating economic growth can create inflationary pressures. For instance, lowering interest rates tends to encourage borrowing, spending, and investment, which can drive up demand and potentially lead to rising prices. On the contrary, efforts to control inflation through higher interest rates can cool economic activity and slow down growth. Thus, central banks must carefully weigh the need for economic growth against the risk of excessive inflation. Short-term stability versus long-term goals. Some monetary policy actions may have favorable short-term effects but could lead to adverse outcomes in the long run. For instance, providing liquidity to financial markets can stabilize them during crisis. But if continued too long, it could encourage excessive risk-taking and asset bubbles. Central banks need to balance immediate needs with long-term economic stability. Unemployment versus price stability. Relationship between inflation and unemployment is represented by Phillips curve, which suggests that low unemployment might lead to higher inflation and vice versa. Central banks pursuing to policies to maximize employment could potentially face rising inflation. This trade-off requires policymakers to consider how employment-focused policies impact price stability and vice versa. That's all. Thank you.
Good morning, everybody. I am Monique Palite and I will be discussing the challenges in implementing monetary policy. Some of the key challenges in implementing monetary policy in different economic conditions are as follows. Number one is high inflation scenarios. When inflation is high, central banks may increase interest rates to cool demand. However, this can slow economic growth and increase unemployment. Balancing inflation control with economic growth is difficult, as overly aggressive rate hikes can lead to recession, while moderate hikes may not sufficiently contain inflation. Number two is global economic interdependence. In an increasingly interconnected global economy, domestic monetary policy can be affected by international factors such as global interest rates, trade imbalances, and capital flows. For instance, U.S. Federal Reserve's decision can impact emerging markets through capital outflows, exchange rate volatility, and imported inflation, complicating domestic monetary policy. Number three is time lags in policy effectiveness. Monetary policy often has delayed effects, as it can take months or even years for rate changes to impact spending, investment, and employment. This lag complicates policy timing, as central banks must predict future economic conditions and risk either overstimulating or undershooting the economy. Number four is uncertainty and incomplete data. Economic conditions are often uncertain, and policymakers rely on data that may be subject to revision. Incomplete or delayed data can lead to policy errors, especially during times of rapid change such as financial crises or pandemics, where real-time information is crucial. Lastly, number five, structural changes in the economy. Shifts in economic structures such as digital transformation, changing demographics, and labor market dynamics complicate monetary policy. For example, an aging population may reduce the natural rate of interest, requiring lower rates to achieve full employment, while technological changes can alter productivity trends and inflation dynamics. That's all. Thank you.